The American real estate market is experiencing a seismic shift in 2026 that's catching millions of homeowners completely off guard. Across the United States, housing markets that seemed unstoppable just 3 years ago are now witnessing price corrections so severe they're rewriting the rules of real estate investing. In some cities, median home prices have crashed by as much as 38% in less than 2 years, wiping out entire life savings and leaving hundreds of thousands of families trapped in homes worth far less than what they owe. What we're witnessing isn't a gradual cooling or a minor adjustment. It's a full-scale implosion of real estate values in specific markets across America, from the Sunbelt cities that exploded during the pandemic to tech hubs experiencing mass layoffs, from retirement destinations facing demographic shifts to suburban sprawl communities built on speculation. The collapse is accelerating with each passing month. The statistics are shocking and undeniable. Across the 12 cities we'll examine today, average days on market have skyrocketed from under 30 days in 2022 to over 150 days in 2022 to over 150 days in 2022 to over 150 days in 2026. Inventory levels have exploded by 400% or more in some metropolitan areas, creating catastrophic oversupply that continues driving prices into freefall. Mortgage rates stubbornly anchored between 7 and 8% have eliminated millions of qualified buyers from the market, while property insurance costs have surged by 60% to 100% in high-risk areas, making homeownership financially impossible for middle-class families. Today, we're investigating the 12 U.S. cities where real estate isn't just declining. It's imploding at a pace that will reshape these communities for decades to come. We'll examine exactly what's driving these devastating collapses, which neighborhoods are being hit hardest, and what the future holds for homeowners, investors, and entire regional economies built on real estate appreciation. To understand why these 12 cities are experiencing such catastrophic real estate implosions in 2026, we must first examine the national forces that have converged to create this perfect storm. The housing market correction we're witnessing represents the bursting of the largest real estate bubble since 2008, driven by fundamentally different dynamics but equally devastating consequences. The Federal Reserve's aggressive monetary tightening campaign has been the primary catalyst. After maintaining near-zero interest rates throughout the pandemic, the Fed raised rates aggressively from 2022 through 2024 to combat inflation. Mortgage rates, which bottomed at historic lows of 2.65% in January 2021, surged to 8% by late 2023 and 0.5% since January 2021, surged to 8% by late 2023, and have stabilized in the 7% range throughout 2025 and into 2026. This unprecedented rate shock has effectively doubled or even tripled monthly mortgage payments for homebuyers compared to the pandemic era. The affordability crisis has reached catastrophic proportions. The typical American household now needs to earn approximately $120,000 annually to comfortably afford a median-priced home in 2026, up from just $59,000 in 2020. This 103% increase in income requirements in just 6 years represents the fastest deterioration in housing affordability in American history. An entire generation of potential first-time buyers has been priced out of homeownership entirely. However, the cities experiencing implosions share several critical characteristics that amplify these national trends. First, they were ground zero for pandemic-era speculation. Institutional investors, individual speculators, and foreign capital flooded into these markets between 2020 and 2022, betting on continued appreciation. When the music stopped, these investors rushed to exit simultaneously, creating panic selling and accelerating price declines. Second, these cities experienced extreme overbuilding. Developers, flush with cheap construction loans and believing pandemic-era demand would continue indefinitely, launched unprecedented building booms. New construction in many of these markets exceeded organic population growth by 300% to 500%, creating massive oversupply that will take years to absorb. Third, many of these cities face severe climate and insurance challenges. Rising sea levels, hurricane risks, wildfire dangers, extreme heat, and water scarcity have transformed from abstract future concerns into immediate crises. Property insurance costs have skyrocketed by 60% to 150% in some markets as major insurers exit entire states. In some Florida markets, annual insurance premiums now exceed $10,000, making homeownership financially impossible for average families. Fourth, these cities lack economic diversification. Markets heavily dependent on single industries, whether tech, energy, tourism, or retirement migration have proven extremely vulnerable to economic shifts. Mass tech layoffs totaling over 400,000 positions nationwide since late 2022 have devastated markets like Austin, Seattle suburbs, and Bay Area communities. Energy sector restructuring has hammered Houston and related markets. Tourism-dependent cities have struggled with changing travel patterns and remote work's impact on business travel. Fifth, many of these cities represent extreme suburban sprawl built on pandemic-era assumptions about remote work. As companies implemented return-to-office mandates throughout 2024 and 2025, bedroom communities located 30, 40, or 50 miles from employment centers have seen demand evaporate. Rising gas prices have made these commutes financially untenable, while the environmental costs of sprawl face increasing scrutiny. The demographic shift affecting retirement destinations cannot be overstated. Stock market volatility, reduced retirement account balances, and economic uncertainty have caused millions of baby boomers to delay retirement or choose less expensive retirement locations. Markets that built entire economies around retirement migration are now experiencing unprecedented inventory surges as the anticipated retiree wave fails to materialize. Finally, the student loan resumption in 2023 removed billions in disposable income from potential first-time homebuyers. Combined with elevated living costs, credit card debt at record levels, and wage growth failing to keep pace with housing costs, the pool of qualified buyers has shrunk dramatically. City number 1, Boise, Idaho. Boise's real estate market has experienced one of the most dramatic reversals in the entire nation. The median home price in Boise peaked at $575,000 in May 2022, but has crashed to $365,000 as of January 2026, a catastrophic 37% decline. Days on market have exploded from an average of 14 days in 2021 to 178 days currently, while active inventory has increased by 485% compared to 2022 levels. Boise was the poster child for pandemic-era migration, with California transplants fleeing high costs and remote workers seeking outdoor lifestyles. However, this migration wave has reversed completely. The work-from-home trend that fueled Boise's boom collapsed as companies implemented strict return-to-office policies. Many California transplants discovered that Idaho winters are harsh. Local wages are 40% lower than coastal markets, and the cultural fit wasn't what they expected. Construction continued at fever pitch through 2024, adding over 18,000 new homes to a metro area of just 750,000 residents. The local economy, heavily dependent on construction and real estate itself, has contracted sharply. Micron Technology, Boise's largest private employer, announced significant layoffs in 2024. Property taxes surged by 35% to 50% as assessed values peaked, then remained elevated even as market values crashed. An estimated 31% of Boise homeowners who purchased in 2021-2026 now have negative equity. The rental market has collapsed with vacancy rates exceeding 16% and rents down 23% from peak levels. Foreclosure filings have increased by 134% compared to 2023. City number 2, Austin, Texas. Austin's transformation from tech darling to housing disaster has been swift and brutal. Median home prices have plummeted from $599,000 in mid-2022 to $385,000 in January 2026 as a devastating 35% drop. Active inventory has exploded to over 9,200 homes, with days on market averaging 100 homes, with days on market averaging 162 days up from just 18 days in 2021. The tech sector's implosion has been Austin's primary killer. Major employers, including Tesla, Meta, Amazon, Oracle, Dell, and dozens of startups, have implemented layoffs totaling over 28,000 positions since late 2022. The Silicon Hills narrative that drove explosive growth has evaporated. Meanwhile, construction continued relentlessly, with over 52,000 new housing units delivered between 2022 and 2027, creating catastrophic oversupply. Texas's property tax burden has become particularly acute in Austin, where annual bills exceeding $15,000 are common on median-priced homes. Combined with mortgage payments at 7.5% rates, homeownership costs are unsustainable for most. The premium that buyers once paid for Austin's culture, music scene, and lifestyle has completely disappeared. Surrounding suburbs like Round Rock, Cedar Park, Pflugerville, and Kyle have experienced even steeper declines of 30% to 38%, leaving entire communities financially devastated. City number 3, Phoenix, Arizona. Phoenix's real estate implosion has been exacerbated by unique environmental challenges. Median home prices have crashed from $485,000 at peak to $315,000 currently, a 35% decline. Some outlying suburbs like Buckeye, Queen Creek, and Casa Grande have seen prices collapse by 35% to 40%. Active inventory stands at over 15,000 homes metro-wide, with days on market averaging 156 days. Water scarcity has transformed from a distant concern into an immediate crisis. Construction moratoriums in multiple communities due to inadequate water supplies have created profound uncertainty about Phoenix's long-term viability. The Colorado River crisis and groundwater depletion have national media attention focused on Phoenix's sustainability challenges. Extreme heat has intensified, with Phoenix recording 143 consecutive days above 100 degrees Fahrenheit in 2023, making outdoor living nearly impossible for 4 months annually. Electricity costs for air conditioning routinely exceed $450 monthly during summer. Property insurance premiums have surged by 65% since 2022. The California migration wave that fueled growth has reversed as remote work ended and climate concerns mounted. Overbuilding has been extreme, with entire master plan communities sitting largely vacant. Phoenix's economy, heavily dependent on construction and real estate, has contracted sharply with widespread layoffs. City number 4, Las Vegas, Nevada. Las Vegas has experienced a real estate implosion that mirrors its casino economy's boom-bust cycles. Median home prices have crashed from $385,000 at peak to $305,000 currently, a 37% decline that represents one of the steepest drops nationally. Active inventory has exploded to over 8,700 homes, with days on market averaging 171 days. Las Vegas's vulnerabilities are multiple and severe. The tourism economy remains below pre-pandemic levels as business travel has permanently declined and consumer spending patterns have shifted. Conventions, which drove midweek hotel occupancy, have not returned to previous levels. The labor market is heavily weighted toward lower-wage service positions that cannot support homeownership at any price level. Water scarcity from Lake Mead's ongoing decline threatens the metro area's long-term viability. Las Vegas has implemented strict conservation measures and faces potential growth restrictions. Extreme summer heat exceeding 115 degrees Fahrenheit has made outdoor activity dangerous. Investors flooded the market during the pandemic boom, with speculation accounting for over 35% of purchases. These investors are now panic selling, creating cascading price declines. The education system ranks among the nation's worst, making Las Vegas unattractive to families. Crime rates have increased significantly. Overbuilding in outlying areas has created ghost subdivisions with minimal services. Many homeowners who relocated from California discovered that Nevada's lower taxes are offset by inferior services and harsh living conditions. City 5, Cape Coral, Fort Myers, Florida. Southwest Florida's real estate market has been devastated by Hurricane Ian's 2022 impact, combined with broader market forces. Median home prices have crashed from $425,000 at peak to $265,000 currently, a 38% decline that represents the worst collapse on our list. Active inventory has surged to over 6,200 homes in the Cape Coral Fort Myers metro, with properties sitting for an average of 184 days. Hurricane Ian's $112 billion in damage fundamentally altered the region's risk profile. Property insurance has become either prohibitively expensive or completely unavailable. Annual insurance premiums now range from $8,000 to $15,000 for typical homes, with many insurers exiting Florida entirely. Some homeowners cannot obtain insurance at any price, making mortgage financing impossible. The retirement migration that historically supported this market has collapsed. Prospective retirees are choosing other destinations due to hurricane risk, insurance costs, and extreme heat. The median age exceeding 60 creates demographic challenges as aging residents downsize or relocate to be near family. Construction that accelerated through 2023 created massive oversupply just as demand evaporated. Many investors who purchase vacation rentals are facing negative cash flow as rental rates collapsed and insurance costs surged. The rental market has vacancy rates exceeding 18%. Foreclosures have increased by 156% as homeowners simply walk away. Climate change concerns about sea level rise and hurricane intensification have made long-term investment in Southwest Florida increasingly questionable. City 6, Miami, Fort Lauderdale, Florida. South Florida's real estate bubble has burst spectacularly despite the region's global city status. Miami's median home prices have declined from $625,000 at peak to $425,000, currently a 32% drop. Fort Lauderdale has declined 35%. The luxury segment above $2 million has crashed by 40%. Active inventory exceeds 22,000 homes metro-wide, with days on market averaging 147 days. The insurance crisis has hit South Florida particularly hard. Major insurers have abandoned the state entirely, leaving property owners dependent on Citizens Property Insurance, the state-backed insurer of last resort with premiums 150% higher than private market rates from 2020. Annual insurance costs of $12,000 to $25,000 are now common, making ownership financially impossible for middle-class families. The foreign investment that drove South Florida's luxury market has evaporated. Russian, Venezuelan, and Brazilian buyers disappeared due to economic and political turmoil. Chinese capital, once a major force, has been restricted by government policy. Cryptocurrency millionaires who drove speculation in 2021-2022 have seen their wealth evaporate. Condo collapse concerns following the Surfside tragedy have created unprecedented liability and insurance challenges for older buildings. Many condo associations face special assessments exceeding $100,000 per unit for required inspections and repairs, forcing sales and depressing values. Sea level rise is no longer theoretical. Flooding during high tides is increasingly common in coastal areas. Traffic congestion has reached crisis levels with no infrastructure solutions in sight. City number 7. Tampa. St. Petersburg, Florida. Tampa Bay has experienced a real estate implosion that rivals Southwest Florida's severity. Median home prices have crashed from $425,000 at peak to $285,000, currently at 33% decline. Active inventory stands at over 11,500 homes, with days on market averaging 168 days. The insurance crisis is equally severe in Tampa Bay, with annual premiums now averaging $9,000 to $14,000 for typical homes. The region's hurricane vulnerability directly in the path of major storms, combined with dense coastal development, has made insurers flee the market. Property taxes have remained elevated even as market values crashed, with annual bills often exceeding $8,000. Tampa's economy, while more diversified than some Florida metros, remains heavily dependent on real estate, construction, and tourism, all sectors in severe contraction. The tech presence that briefly emerged during the pandemic has evaporated with layoffs and remote work reversals. Overbuilding has been extreme, particularly in outlying suburbs like Riverview, Wesley Chapel, and New Tampa, where prices have declined 35% to 40%. The rental market has collapsed under investor liquidation, with vacancy rates exceeding 14%. Traffic congestion on I-275 and I-4 has become unbearable, with no solutions in sight. The retirement migration wave has not materialized as anticipated. Climate concerns about storm surge and flooding are increasingly influencing buyer decisions, with waterfront properties particularly affected. City number 8. Raleigh-Durham, North Carolina. The Triangle's reputation as a stable, growing tech hub has been shattered by the 2026 implosion. Median home prices have declined from $355,000 at peak to $335,000, currently a 31% drop. Active inventory has surged to over 7,800 homes, with days on market averaging 142 days. The Research Triangle Park, along the region's economic engine, has experienced massive tech layoffs totaling over 12,000 positions since 2023. Companies including Cisco, Red Hat, and numerous biotech firms have implemented significant cuts. The remote work reversal has hit Raleigh-Durham particularly hard, as many transplants discovered they no longer needed to live in North Carolina. Overbuilding has been egregious, with construction continuing at record pace through 2024 despite clear demand weakening. Suburbs like Cary, Apex, and Holly Springs saw explosive growth that created massive oversupply. Investors who purchased heavily in 2021-22 are now liquidating at substantial losses. Property taxes have increased by 40 to 60% as local governments struggle with infrastructure demands from rapid growth. The premium that buyers once paid for North Carolina's combination of affordability, jobs, and quality of life has evaporated as prices surged while wages stagnated. Many California and Northeast transplants are returning to their origin states. The universities provide stability but not growth sufficient to absorb the housing stock added during the boom. City 99, Nashville, Tennessee. Nashville's transformation from music city to housing disaster has shocked residents and investors alike. Median home prices have crashed from $525,000 at peak to $355,000 at peak to $355,000, currently a 32% decline. Active inventory has exploded to over 1,800 homes, with days on market averaging 136 days. Nashville was overwhelmed by pandemic migration from California, the Northeast, and Midwest, with over 100 people moving to the metro daily at peak. This wave has reversed completely as remote work ended and the cost of living surged. Construction exploded with over 45,000 new housing units delivered between 2021 and 24, creating catastrophic oversupply in a metro of jetting 24, creating catastrophic oversupply in a metro of just 2 million residents. The healthcare and music industries, Nashville's traditional economic base, cannot support the housing stock built during the boom. Tech presence that briefly emerged has contracted sharply with layoffs. Traffic congestion has become unbearable on I-65, I-40, and I-24, with infrastructure failing to keep pace with growth. Property taxes increased by 50% to 70% as the city struggled to provide services for rapid population growth. The tourism economy has not recovered to pre-pandemic levels on inflation-adjusted basis. Bachelorette parties and honky-tonk tourism cannot support a housing market. Investors who purchased heavily in neighborhoods like the Gulch, East Nashville, and Germantown are facing devastating losses as the rental market collapsed. Vacancy rates exceed 13% and rents have declined by 21% from peak levels. City number 10, Charlotte, North Carolina. Charlotte's banking and financial services hub status has not protected it from real estate implosion. Median home prices have declined from $445,000 at peak to $315,000, currently a 29% drop. Active inventory stands at over 6,900 homes. Active inventory stands at over 1,600 drop. Active inventory stands at over 6,900 homes, with days on market averaging 138 days. The banking sector, while providing stability, has contracted with significant layoffs at Bank of America, Wells Fargo, and Truist, totaling over 8,000 positions. The fintech boom that emerged during the pandemic has reversed sharply. Remote work reversals have eliminated many high-paying positions that supported Charlotte's housing market. Overbuilding has been severe, particularly in suburbs like Huntersville, Concord, and Ballantyne, where speculative construction continued through 2024. Investors accounted for over 32% of purchases in 2021 to 22 and are now liquidating en masse. Property taxes have increased by 45% since 2020 as the city struggles with infrastructure for rapid growth. Charlotte's appeal as an affordable alternative to Northeast and West Coast cities has diminished as prices surged during the boom. Many transplants discovered that North Carolina's lower taxes are offset by inferior public services and infrastructure. Traffic congestion has worsened significantly. The rental market shows vacancy rates above 12%, with rents declining 18% from peak. City number 11, Salt Lake City. Utah. Salt Lake City's real estate market has imploded despite the state's strong demographic fundamentals. Median home prices have crashed from $625,000 at peak to $455,000, currently a 34% drop. Active inventory has surged to over 5,200 homes, with days on market averaging 165 days. The tech corridor along I-15 experienced massive layoffs totaling over 15,000 positions since late 2022, devastating markets in Lehigh, Draper, and Provo. Companies including Adobe, Qualtrics, and numerous startups implemented significant cuts. The Silicon Slopes narrative that drove explosive appreciation has evaporated completely. Air quality has become a critical concern, with winter inversions creating some of the nation's worst pollution. Water scarcity from the Great Salt Lake's decline threatens long-term sustainability. Ski resort access that justified premium pricing has deteriorated with climate change reducing snowpack. Overbuilding in suburbs like Harriman, Saratoga Springs, and Eagle Mountain created massive oversupply far from employment centers. Property taxes increased by 55% to 70% as local governments expanded services for rapid growth. The premium buyers once paid for outdoor recreation access and quality of life has largely disappeared. The rental market has collapsed with vacancy rates exceeding 14% as investors liquidate. Many California transplants who moved during the pandemic are now returning, citing cultural fit issues and harsh winters. City number 12, Spokane, Washington. Spokane's real estate implosion has been particularly severe given its smaller market size. Median home prices have crashed from $465,000 at peak to $295,000, currently a 37% decline. Active inventory has exploded by over 520,000 compared to 2022. With days on market averaging 189 days, Spokane was overwhelmed by Seattle transplants seeking affordability during the pandemic. This migration wave reversed completely as remote work ended and many discovered Spokane's harsh winters, limited amenities, and cultural differences. Construction continued at record pace through 2024, adding thousands of homes to a metro area of just 600,000 residents. The local economy, dependent on healthcare and education, cannot support the housing stock built during the boom. Average wages are 35% below Seattle levels, making homes unaffordable even at reduced prices. Property taxes increased by 60% as the city struggled with rapid growth demands. Air quality from wildfire smoke has become a serious health concern during summer months. Investors who purchased rental properties are facing catastrophic losses as vacancy rates exceed 17% and rents have declined by 26% from peak levels. Many homes sit vacant for 6 months or longer. Foreclosure filings have increased by 178% as owners walk away from deeply underwater properties. The rental market oversupply will take years to absorb. Several critical themes emerge from analyzing these 12 imploding markets that reveal the structural forces reshaping American real estate. The most striking commonality is that pandemic-era assumptions proved catastrophically wrong. Remote work did not permanently change location preferences. Migration from high-cost to low-cost states was not permanent. Housing prices could not appreciate indefinitely regardless of fundamentals. The second major theme is the devastating impact of speculative excess. Markets where investors accounted for 30 to 40% of purchases during the boom have experienced the steepest declines as these investors rush to exit simultaneously. The assumption that housing was a one-way bet has been decisively disproven. The third critical theme is climate and environmental vulnerability. Markets facing water scarcity, extreme heat, hurricane risk, wildfire danger, or flooding are experiencing both immediate insurance crises and long-term viability questions. Climate change has transformed from an abstract future concern into an immediate economic factor affecting housing values. The fourth theme is the fragility of single-industry economies. Markets dependent on tech, energy, tourism, or retirement migration have proven extremely vulnerable to industry-specific shocks. Economic diversification is essential for housing market stability. The fifth theme is infrastructure failure. Rapid growth overwhelmed roads, schools, water systems, and public services in many markets. Buyers who moved during the pandemic discovered that lower taxes often meant inferior services and quality of life. These implosions are creating broader economic damage. Consumer spending has contracted sharply as homeowners feel poorer. Property tax revenues are declining as assessed values drop, forcing municipal budget crises. Construction industries have collapsed with mass layoffs. Banks face mounting losses on mortgage portfolios. The psychological impact of negative equity is affecting millions of Americans' confidence in homeownership as wealth building. Looking nationally, these 12 markets serve as warnings for others showing early signs of similar dynamics. Markets in Georgia, South Carolina, Montana, and elsewhere that experience pandemic booms are beginning to show cracks. The pattern is clear explosive appreciation driven by speculation and migration rather than economic fundamentals leads to eventual implosions. The real estate implosions in these 12 U.S. cities represent one of the most significant housing market corrections since the 2008 financial crisis. Price declines ranging from 29% to 38%. Median home values down $100,000 to $310,000 from peak levels. Inventory explosions of 400% to 520%. Hundreds of thousands of homeowners underwater on their mortgages. Entire regional economies built on real estate appreciation now contracting sharply. These aren't just numbers. They represent profound financial devastation, shattered dreams, and economic uncertainty affecting millions of American families who believed they were making sound investments in their futures. For current homeowners struggling with negative equity and declining values, the crucial insight is that housing must be viewed through a long-term lens. If you can afford your monthly payments and don't need to sell immediately, riding out the downturn is almost always preferable to selling at catastrophic losses. Home values will eventually stabilize, even if recovery to peak prices takes a decade or longer. For prospective buyers, these markets present opportunities not seen since 2011-2012. Prices have returned to 2018 or 2019 levels in many areas, and desperate sellers are negotiating aggressively. However, approach with extreme caution and realistic expectations. Purchase only what you can comfortably afford at current interest rates. Focus on markets with diversified economies, climate stability, and proven long-term fundamentals. Plan to hold for at least 10 to 15 years. For real estate investors, the lesson is brutal and unforgiving. Speculation and leverage are catastrophically dangerous when fundamentals shift. Those who avoided the pandemic frenzy and maintained substantial cash reserves can now acquire properties at significant discounts. However, exercise rigorous due diligence, focus on cash flow rather than appreciation, and prepare for years of weak rental markets and slow recovery. Looking ahead, these markets should begin stabilizing by late 2026 or 2027, as excess inventory is gradually absorbed and prices reach levels genuinely supported by local incomes. Recovery will be slow, painful, and uneven. Some markets may not see full recovery to peak prices until 2032 or beyond. Markets facing severe climate or water challenges may never fully recover. The real estate implosions of 2026 will be studied for decades as a case study in speculation, pandemic-era decision-making, and market psychology. For those living through it, the experience is financially and emotionally devastating but ultimately survivable. Housing markets are cyclical. The pandemic boom was abnormal and unsustainable. The 2025-2026 implosion is a harsh correction, and eventually more stable markets will emerge. The question is whether we'll learn the lessons this time or repeat the same mistakes in the next cycle.